Sanjay Mookim is with us. He's our market master of the day, strategist, head of India equity research at JPMorgan. Sanjay, good to have you with us here. Thank you very much. Once again, we are, in a way, if world markets can be described as a bit of a race, we are leading the pack, back at almost all-time highs in the fastest way possible. Almost there, not quite. What's your own sense, Sanjay? How are things looking? Does the price action match up with the earnings which we are getting and the situation on the ground? What's your sense?
Morning, it's great to be on. We've argued in our notes that India was set for a bit of a rally. And there are two or three things that I think favored us. One, valuations have come off. On the Nifty, at least, we were at peak of 22, we were down to 17.5-ish on lows. But more importantly, the premium that India had acquired to the S&P 500 last year, for a variety of reasons, all those premiums had completely eroded by the middle of, let's say, March or late Feb. And that kind of brought us in on a more favorable relative value platform, which was good for a lot of clients to look at. The second is that India's macro conditions have improved meaningfully. And principally, when we talk of that, we mean the pressure that we had on dollar outflows and RBI reserves falling because of a very wide current account deficit. That has, for again, a variety of reasons, compressed meaningfully. So it gives the RBI room to be a little bit more pro-growth, not have to raise rates further. And more importantly, when you look at India relative to peers in EM or Asia, that kind of makes India look a little bit more favorable. The third thing that we have argued is that the sentiment on China has again turned negative for a while. And this is largely because the market is not going anywhere for quite a few weeks now. So client interest has moved from this big reopening of China trade back to looking for other ideas in Asia or EM. And again, India then becomes a favorable candidate within that. The last thing, Nigel, that we have argued in our research is that the business cycles indicators in India, whether it is jobs, whether it is wages, whether it is consumer confidence or corporate utilizations, they're all moving in the same direction. So given a couple more quarters, we do expect that whatever current narrative of weakness we have on consumption, even that should start to get addressed and fixed. So all these 4 or 5 things and the market having corrected kind of set up us for a big rally. I'm just surprised at the pace at which India's caught up very quickly, not giving too many people opportunity to participate, unfortunately.
All right. I just wanted to point out, by the way, one of the stocks of the moment is TVS Motor. It's hit a fresh 52-week high right now, and the stock is up almost 6%, so handsomely rewarding those earnings. It's not been a great year. I mean, it's been a good year, but nothing exceptional for TVS. It's up about 13% this year. But Sanjay, I wanted your thoughts. Some of these spaces that are barometers of rural and urban demand are picking up. So whether it's something like a TVS Motor, some of these companies in the FMCG space, but particularly for two-wheelers, how are you feeling about that space? Do you think the worst is over? And for investors, is there anything here?
Without talking about a specific stock, of course, Sonia, we do like the two-wheeler space conceptually, and the starting point is very simple. The aggregate sales of two-wheelers are still below where they were pre-pandemic, whereas every other sector in India has reopened and more. Four-wheeler sales are well ahead of where they were in 2019. Two-wheeler is not fully reopened. That is still due, and we're starting to see this happen. Now, whether this is driven by an improvement in credit flow, it is driven by the improving consumer confidence that I talked about earlier. There could be a variety of things that we could attribute this to. But essentially, we believe that the volume momentum we're seeing in the sector should continue. There are companies which are benefiting from it. Overall, we really like the two-wheeler space as being one that can benefit from this improvement in mass market consumption that we anticipate for this year.
All right. Hi, Sanjay. Good morning. Nigel on this side. Sanjay, when we chatted last in March, when you all were calling for a bit of a rally, the headline index, I think, is up a good 1,000 points. But I recall you telling us that from the broader markets and mid-caps, you don't mind missing the first 10% odd. But you'll want the markets to stabilize and then get in. Now, given that the headline index has gone up and maybe the headroom for the headline index is a little bit limited, is it now time to move more towards mid-caps? Incremental allocation goes to mid-caps, or you'll still stick with the large caps?
I'd still stay with the large caps. And what makes me a little bit nervous is that the valuations for the mid-caps haven't really corrected. I mean, by correction, I'm not even asking for them to become cheap. even to get back to where they were pre-pandemic. In general, most of the smaller stocks are not there yet. They're still carrying a premium which is very unjustifiable. The growth outcomes for many of these smaller sectors is actually worse than that of the large caps. So you have adverse valuations and adverse growth. Yes, there is longer term potential for the smaller companies to grow faster eventually, but at some point, this needs to show up in evidence. And given that there has been this rally at a time when the global macro remains weak, and you must remember that while we're talking of everything in India playing out in line with those 4 or 5 things that I spoke about, there is this Damocles sword of a bit of a crisis in equities globally. Should the market worry about Fed actions or US bank crisis or commercial real estate? There's a whole list of candidates that could spoil this party. So I don't want to stick my neck out and add beta even to Indian portfolios when I have a set of Indian large caps which will give me very decent compounding returns at decent valuations anyway.
Sanjay, we had Jahangir Aziz yesterday from JPMorgan, and I asked him about oil. And he said, well, what we're seeing right now, oil coming off, he said, I don't read it as positive. Basically, the oil market is divergent with equity markets, and it's perhaps forecasting a much steeper slowdown, global slowdown. So he said, well, I don't read it as positive. Your thoughts, and how does that relate to stocks and earnings? If oil were to stay here, what's your sense?
2 things. One, predicting oil has been the most challenging thing that anybody's...
Not predicting. Let's assume it stays here. After this 10% drop, we don't see... Many are still calling for it to go back to 100. I mean, who knows? But let's assume it stays at around the $72.
That will be very good for us, right? Because we are the second largest importer of oil in the world. It affects our balances. It affects the disposable income for consumers. So we'd love for oil to stay here. But Jahangir's point was right, that look, even after so much of OPEC action in cutting production, trying to tighten demand supply, if you see prices react negatively steadily, it's a very bad indicator of the perception of demand. Now, that might change eventually if demand comes back and China reopens stronger than people expect. But for now, oil is a signal of relatively weak demand on the ground. This is something that actually makes India stand out positively relative to EM. The 20-year chart of India relative to EM correlates to oil beautifully.
Okay. By the way, now the tire space has started to pick up quite a bit. Not the ones that have reported numbers, but the ones that are pending. So JK Tires is the one that's surging now, 5% higher. In fact, this entire piece, all the auto ancillaries also moving up with quite a bit of strength. But Sanjay, the other space that has looked very good, at least on ground, is real estate. From a stock market angle, is that a space that you still like? Do you think it's a multi-year upcycle that we're staring at?
We have liked it for quite a while, actually, Sonia, and we persist in that view. The concurring or the regular data points that we get on demand in terms of existing inventory or even new launches is pretty strong. There was fear that the rise in mortgage rates would kill the cycle. We are actually not seeing any of that happen at the moment. It is encouraging to my mind, and stocks haven't really done much. They've been hanging around for a while, perhaps because of these concerns on mortgage rates, perhaps because of the read-through of global real estate and so on. But the cycle remains robust, and we really like the space as something that should structurally continue for the next few years.
All right, Sanjay, what about IT? You all have got it bang on till date. We have seen a lot of headwinds out there. Commentary hasn't been great as well. One would think there's no big reason to buy IT, with the kind of headwinds that we have, even at these valuations. But what if we see a correction of, say, 5 to around 10% on IT names? Will the large cap start looking attractive then? Because you all have had an underweight call on IT, and you all are maintaining that.
Yes, we are. Now, there are 2 responses to this. If you were to, let's say, on some of the large caps, value this on a long-term DCF, maybe the downside to some of the specific big ones may not be more than, let's say, 10 or 12% on a normalized growth assumption, right? The challenge we have is the timing of this trade, or to switch into IT perhaps, because the down cycle and top line, the down cycle and profitability has only just started. The weakness we've seen in the March quarter doesn't even factor in the challenges in the small banks in the US. And the effect of that will probably flow through in the June and September quarters eventually. Maybe you can make the case that there is at best a 10-15% downside to a reasonable fair value. but there is always the risk that these stocks undershoot into the steady down cycle that we fear will come. We wouldn't jump in to buy any of these just yet.
Okay. All right, we will leave it at that. Sanjay, thanks a lot for joining in and taking us through your view. Appreciate your thoughts on CNBC TV18. By the way,